Welcome to the Deep Dive. Today we're taking a close look at Stagwell, ticker STGW, and their Q2 2025 earnings call. It was a pre-market report, and wow, the stock jumped over 11% almost immediately.
Yeah, a really strong reaction. And you can see why. It wasn't just about hitting the numbers. I think the market really responded to the strategic clarity they offered, moving away from that old holding company model.
Towards what they're calling a tech-forward, agile machine.
Exactly. So we're going to break down the key numbers that pop the stock, but maybe more importantly, look at their H2 roadmap. It's ambitious.
Okay, let's unpack those headline financials first. They definitely looked constructive.
Yeah, very much so. Reported revenue, $707 million. That was, comfortably above what analysts were expecting. Consensus was more like $696 to $700 million.
But net revenue is really the key metric in this sector, right?
That's the one to watch. It came in at $598 million. That's solid 8% year-over-year growth. But management really hammered the point about the 10% growth when you strip out the advocacy business.
Right, and maybe explain that for our listeners. Advocacy revenue can be unpredictable.
Totally. It's often political stuff, campaign work, high margin when you get it, but very volatile.
Yeah.
So taking it out gives you a much cleaner view of the core enterprise marketing growth. And seeing 10% growth there, that's pretty impressive.
Okay, and drilling down, adjusted EPS.
Came in at 17 cents, pretty much bang in line, maybe a slight beat by a penny, depending on whose consensus you used.
And adjusted EBITDA.
$93 million. Which gives you a 15.5% margin on that net revenue figure. Respectable numbers.
Respectable, yeah. But you mentioned the market reacted strongly. It feels like there was something more fundamental moving the needle. Was it the cash flow?
Absolutely. That was, I think, the real operational highlight that signaled discipline. If there's one number you remember, make it this. A $122 million improvement year to date in operating cash flow.
Wow, $122 million swing. That's massive.
It is. And it marks their first ever positive Q2 cash flow from operations. That's usually a tougher quarter in the agency world.
So counter-cyclical.
Exactly. And management was clear this wasn't just luck. They credited new tech, giving them better real-time visibility and just, much tighter working capital management.
Okay, so connect the dots for us. What does that big cash flow swing really mean for an investor? Sounds a bit dry, maybe?
Yeah, it can sound dry, but it's fundamental. It signals sustainability. It signals lower risk. Cash flow, at the end of the day, it fuels everything else, paying down debt, M&A, and crucially, share buybacks.
Okay.
So when a company like Stagwell generates positive cash in a seasonally weak quarter like Q2, it proves they really have control over the balance sheet. And it puts them squarely on track for their full-year target over 45% free cash flow conversion, meaning a big chunk of profit turns into actual cash they can use.
Got it. So that discipline underpins the whole investment thesis.
It really does.
Okay, so let's pivot then. Beyond the quarterly numbers, let's talk about that structural story, the part that really seemed to excite the market. The AI angle, the efficiency gains, this machine concept.
Right. This is the core differentiator they're pitching. And the investment is real. They're spending about $20 million per quarter.
In OPEX.
Yeah, operating expenses, specifically funneled into AI initiatives. And the goal isn't just like tweaking things around the edges. It's a structural overhaul, building this unified internal platform, the machine, and plugging it into an Adobe-based content supply chain system.
Okay, the machine sounds impressive, but what does it do? Management's making a big claim here, about 15% cost reduction and better quality output. By early 2026, that 15% efficiency number, is that realistic? Agencies run on expensive people, and those overhead costs can be really sticky.
That's the multi-million-dollar question, isn't it? The 15% hinges on, basically two big things. First, automating the really repetitive, high-volume creative stuff, what they call the production grunt work.
Right.
By wiring up Adobe with their internal tools, they think they can slash the human touch points needed to customize and blast campaigns out across, 50 different channels.
Okay, that makes sense. And the second part?
Better resource use. The machine is supposed to connect data, people, software across your whole network. So less wasted time, less internal friction, maybe less duplication of effort. This is how they're positioning against the slower scale burden holdcos. Betting technology and agility beats sheer size.
And it seems like that message, the tech-forward pitch, it's landing with clients right now.
The numbers suggest it is. Look at the Marketing Cloud segment. Net revenue up a huge 28% year over year.
And even higher if you exclude advocacy again.
Yeah, 38% ex advocacy. That's really strong. It suggests clients are buying the platform story, not just, traditional services. They specifically called out their Harris Quest Research Suite, 100% organic growth there after some product upgrades.
So clients aren't just hiring them for ads, they're buying Stagwell's own tech for research, for data. That's stickier.
Much stickier revenue, exactly.
And that momentum, it's feeding the pipeline. Net new business looks strong again.
Yeah, NNB, $117 million in Q2. That pushes the trailing 12 months figure to $451 million.
And that's the 5th quarter in a row over the $100 million mark.
5th straight quarter. Consistency. And look at the quality of those wins, too. Net revenue from their top 25 clients, up 26% year over year to $175 million.
Wow.
The average spend for those top clients is now $28 million a year. That tells you the big guys are consolidating more spend with Stagwell.
Probably because of that integrated offering, creative, data, media, all linked up.
That seems to be the driver, yes.
Okay, let's talk capital allocation.
Yeah.
Because the moves on the balance sheet, they sort of back up management's confidence, right? They bought back stock.
They did. Put that improved cash flow to work. Repurchased about 9.6 million shares. Spent roughly $48 million.
Average price.
Around $4.95 per share. And this is key. There's still $160 million left on the buyback authorization.
$160 million remaining. That's a pretty big chunk relative to their market cap.
It's a massive tool. Gives them a lot of firepower to support the stock price going forward, especially if they see dips. It shows confidence.
And M&A. They did a couple of deals. ADK GLOBAL in Asia, JetFuel for retail marketing.
Yeah, they were active, but they also signaled a shift. They basically said external M&A is going to slow down now.
Oh, interesting. Why?
The focus is pivoting. Less buying, more integrating. They've bought a lot over the last 18 months or so. Now it's about plugging those acquisitions properly into the machine.
Making sure it all works together. Disciplined.
It's a necessary step, yeah. And related to that discipline, their internal cost savings program, it's actually running ahead of schedule.
The $80 to $100 million target by 2026?
That's the one. They've already executed $20 million in annualized savings so far this year. And about $7 million of that actually hit the adjusted EBITDA line this quarter. So real savings flowing through.
Okay, so let's tie this all together. We have improving cash flow, tech investment, driving efficiency, strong client growth, buybacks, cost savings. The market seems to be buying the H2 acceleration story. What's the logic there? Why should things get better in the second half?
Well, part of it is just typical industry seasonality. Client churn tends to be lower in H2.
Right.
Media spending picks up heading into the holidays. And critically for Stagwell, those big new client wins they've announced, GM, Visa, Adobe, Target, those contracts should be ramping up fully in the second half.
So pulling all that together, they expect organic growth to get back into what range?
High single digits, maybe even touching double digits in H2. That's the projection.
And crucially, they held the full year guidance steady. That always helps market confidence.
Absolutely. Reaffirmed everything. Total net revenue growth around 8% for the year. Adjusted EBITDA still in that $410 to $460 million range.
Adjusted EPS $0.75 to $0.
Yep. And that free cash flow conversion target still over 45%.
And the leverage goal, that seems important long term.
Very important. They want to finish the year with net leverage in the twos. It was 3.18x this quarter. Getting into the twos would be a big improvement.
Signals financial strength, lower risk profile.
Exactly. Makes them more resilient. Oh, and one other thing on new revenue. The launch of the government contracts division.
Right. That's new.
Management has experience here. They think this could eventually be 10%, maybe 15% of the whole business. And those contracts are often multi-year, like 3 to 5 years. So add stability.
Okay, good context. Let's tackle a question that's been floating around for a while, especially with Marketing Cloud doing so well. The spinoff rumors, did they address that?
They did, quite directly. They basically said a spinoff is, quote, a ways off.
Pouring some cold water on that idea for now.
Yeah, exactly. The market needed that clarity. They laid out 2 conditions, essentially. First, they need to at least double Marketing Cloud revenue from current level.
Okay, so significant growth still needed.
Significant growth.
Yeah.
And second, they need more of the products within that division to be proven hits, kind of like Harris Quest is becoming. The bottom line is they want to make sure the parent company gets full value if they do spin it out, not rush it at a discount.
So realistically, maybe mid-2026 or later for any kind of separation.
That feels like the earliest plausible timeline based on what they said, yeah.
All right. Disclaimer time. We are analysts. We talk about market data, earnings calls, strategy. Nothing we say here is financial advice. Always do your own research, consult your advisor. Okay. With that said, let's get to the fun part, the trade idea that emerges from this deep dive.
All right. So given everything we've discussed, the efficiency gains coming online, the cash flow funding, that big buyback, we see a potential pair trade here. The idea, long STGW, short a scale-burdened legacy holdco.
Okay, interesting. Long agility, short inertia. Why this specific trade right now based on this call?
Well, look at the valuation. The market, it still seems to be valuing Stagwell like a standard cyclical agency. Just look at its lag versus the XLC sector ETF over the past year.
Right, I haven't kept pace.
But this call, it really drove home that the cost structure is fundamentally changing. You've got the $20 million in confirmed annualized savings already, plus that clear path, that roadmap to 15% efficiency from the machine. That creates a margin expansion story that isn't just about the economy getting better. It's structural. It's internal.
So the bet is that the gap between the promised tech efficiency and the actual realized margins, that gap closes faster than people think.
Exactly. Faster than the market expects. And you've got two potential fuels for that re-rating, that massive $160 million buyback authorization providing support and buying shares back cheap.
And the accelerating organic growth kicking in during H2 as those big clients ramp up.
Precisely. So it's a bet on execution, a relatively low leverage company using tech to get nimble versus the sheer inertia of the giant legacy players.
Makes sense. Okay, let's wrap this up.
Yeah, I think the big picture here is a company hitting its marks on cash flow, making smart strategic moves with AI and M&A integration, cleaning up the balance sheet, and laying out a pretty clear path to better margins. The stock bump, that was confidence in the H2 story they told.
So for you listening, what should you watch? The key catalyst really is converting that record pipeline, that net new business, into actual H2 revenue. And maybe even more importantly, getting tangible proof points that the $20 million per quarter they're spending on AI actually delivers that promised 15% efficiency gain down the line.
Execution, that's the name of the game now.
All right, let's leave you with a final provocative thought. Management keeps hammering this idea. Effective technology, not scale, is what matters in media now. So the question is, will their approach combining their own Stagwell ID graph data with this internal machine platform, will that really be enough to disrupt the giant media agencies who command billions in buying clout and volume discounts?
Or is scale still king when it comes down to buying ads? That's the big strategic tension to keep an eye on as Stagwell keeps building.